Welcome to KAPP's online classroom. In today's class, we are going to talk about some basic financial concepts. If you understand those financial concepts, understanding of accounting will be very easy for you. The topics we are going to cover in today's class will be the meaning of accounting, what are the objectives of accounting, the methods we follow, the financial statements, people who use financial statements, and what are the characteristics of financial statements. First thing we have to understand is what is accounting. In very easy term, accounting is nothing but recording of a transaction, summarizing it, and interpreting it. Any transaction which can be converted into monetary terms has a place in accounting. Accounting talks about those transactions in detail. We have to record those transactions in a systematic manner. So it's called recording of transactions. Then we classify those transactions as per appropriate heads. We summarize those transactions in order to interpret it further. And finally, we try to gather certain information from those records. The basic purpose of accounting is to provide information, primarily financial information. The information is given to all the stakeholders. The stakeholders are those who are involved with the business directly or indirectly. For example, government, employees, management, society, creditors, buyers, suppliers, all these are stakeholders of the business. Then comes a term which is called bookkeeping. Sometimes people consider bookkeeping and accounting as one of the same. But in reality, bookkeeping is just recording of transaction in a systematic manner, whereas accounting is much broader term. Accounting may involve recording, summarizing, interpreting, whereas bookkeeping just record the transaction in a manner which can be used further. So that is the difference between accounting and bookkeeping. Let's move to next topic, which is objective of having accounting. The most important purpose of accounting is to provide financial information to the stakeholders, to the managers, owners, and all interested parties who can be directly or indirectly interested in the business, to keep systematic record. Anything which is not being maintained in a systematic form has no use. So accounting makes sure that records are being maintained in a proper manner. To ascertain the results of the operation. When we make profit and loss account or income statement that reflects the results of the operation, what business you are doing, are you having profit or you are having loss? That is the objective of accounting. Then is to ascertain the financial position of the business. The document which provides this information is called balance sheet. Balance sheet is document which provides the detail of all the assets and liabilities of the business. Accounting also portrays the liquidity position. Liquidity means how easily available cash is to the business. The business needs cash. A company can survive without profit in short run, but a company cannot survive with no liquidity, not even in the short run. So that is why it is very important to understand whether the company is having enough liquidity or not. That is again one of the objectives of accounting. Again, in nutshell, it provides the useful information to investors, and all the stakeholders. That's the main objective of accounting. Methods of accounting. There are two basic methods, single entry and double entry. There was a time when businesses used to follow single entry system. Under single entry system, you do not keep lot of accounts. It's an incomplete system of recording. The businesses used to make only two set of accounts, one for cash book and another is for personal accounts such as debtors, creditors. But that information is really not sufficient to give the information to the stakeholder and to interpret it further. That is why there's something called double entry came into picture. Double entry, as the name suggests, has two sides. One side is called debit, the another side is called credit. Every transaction has impact on two accounts. One account is debited and the second account is credited. That is what we call double entry system. There are certain steps involved in double entry system. When we say systematic recording, that's what we call systematic recording of transaction. The first recording we do is through journals. How to pass journals, how to make ledgers, these are the topic we are going to cover in the next session. But here we are just touching upon those steps. So the first step is preparation of journals. Then we classify those journals into ledgers. Then we make the third step is to make trial balance. Trial balance is just to check the mathematical accuracy of your debits and credits. And fourth step is preparation of final accounts. The final accounts include your income statement, or you may call it profit and loss account, balance sheet, and cash flow statement. Broadly, the accounts can be classified into two major categories, personal accounts and impersonal accounts. Personal accounts, as the name suggests, it is about person. It includes debtors and creditors. Anything which is related to person, that comes under personal account. When we talk about impersonal account, we have again two classifications, real accounts and nominal accounts. Real account deal with properties and assets, whereas nominal account deal with expenses and incomes. So these are major type of accounts. If you understand the type of account and if you understand the golden rule of accounting, trust me, accounting is really not difficult to understand. The three golden rules of accounting. If you understand these three rules, the whole accounting is very simple to understand. All the transaction revolves around these three golden rules. The first rule, which belongs to real accounts. Debit what comes in, credit what goes out. The real accounting deals with properties and assets, as we have just discussed. Anything which is coming to you should be debited. Anything which is going out should be credited. For example, I have bought a car. Now what I have received is car. So my car should be debited, and in return I have given cash to the other party. So what is going out is cash. So my entry should be car account debit, cash account credit. Let's move to the next type of accounting or next rule of accounting, which belongs to personal accounts. Debit the receiver, credit the giver. For example, I have sold something to X. Now, in this case, what entry would we make? I have sold something to X. the thing is going out from me and going to X. So X account will be debited and the thing which is going out should be credited. And finally, there comes nominal accounting, which belongs to expenses and incomes. By default, all gains and incomes, revenues are credited and all losses and expenses are debited. For example, rent paid. Rent paid is an expense for me. So the general entry I will make is rent expense debit, cash credit. Because in this transaction, cash is going out. Now it is not necessarily that one rule will be applied only in one transaction. In one transaction, it could be combination of golden rules too. For example, as we just discussed in the last, rent paid. In this case, expense came into picture and what is going out is cash. So it's a combination of first rule and the third rule. So you have to understand these golden rules properly. Then comes financial statement. I'm sure you may have heard of this term financial statement, final accounts many times. But do you actually understand the meaning of that? Majorly, there are three sets of accounts we make in financial statements. One is called income statement. Some people may call it P&L account or profit and loss account too. The second set is called statement of financial position, which is balance sheet. The balance sheet includes all your assets and liabilities. Your income statement tells the profit and loss of the business. It includes all expenses and revenues. And finally, we make the statement of cash flow. The statement of cash flow is basically a reflector of liquidity of the business, whether the business is making cash or not, whether the company is having enough liquidity or not. So that is why we make statement of cash flow. Then the question arises, for whom are we making the financial statements? It is not just for management or employee. It's for all the stakeholders who are involved with the business in direct or indirect capacity. For example, it could be investors. Investors are also called shareholders or stockholders. It could be both existing and potential investors. Lenders who are giving loan to the business. They will be pretty much interested in knowing what is happening in the company. Then comes employees. It could be both existing and potential and past. Analysts and advisors. They definitely need the financial information of the business to advise the company. So they are equally interested in the financial information. There are certain business contact groups which are very much interested in financial statements, such as customers, suppliers, government, public, or society. End of the day, business use the resources from society. So public is also very much interested in knowing what is happening in the company. Most of the financial informations are published for stakeholders. Any company which is listed with any stock exchange, it is mandatory for them to publish their financial statements. And then comes qualitative characteristics of financial statements. As we have discussed so much about financial statement and we understand the importance of it, it is important to understand what makes the financial statement useful financial statements. The first, it has to be adequate. If financial statement will not give you complete information, it is useless. Half information is always risky. So that is why it has to be adequate. It should include all the relevant information. It has to be timely. When time has gone, there is no use of those financial statements. It has to be presented in timely manner. It should be easily understandable. Not every person who's reading the financial statement is a technical person. The financial statement should be in the format and the language which should be easily understandable to all the users. It should be sufficiently accurate. The word we use, sufficiently, it's not always possible to give 100% accurate information because of lot of reasons. But at least it should be sufficiently accurate because investors are going to trust this information. They may invest in the business trusting that information. So at least it has to be accurate up to an extent. It should be compatible with the responsibility and needs of user. If users are looking for certain information, then the financial statement should fulfill that requirement. That's all about today's class. We have tried to make this class very short and compact so that you can understand those concepts fully. In case you have any query or any question, you can contact us anytime. Our website is onlineglobalcareer.com. All contact informations are given on the website. You can be in touch with us for all your queries and questions. Stay tuned. We'll be coming back with few more lectures on accounting. Take care.